In 1717, the price of gold was fixed at £4.25 per ounce. That single act by Isaac Newton, yes, the physicist, quietly launched the first modern currency regime. 3 centuries later, the cycle continues. Every time a monetary system starts to unravel, gold moves first, quietly but with precision, not in panic, in protest. In 1968, gold broke free from the $35 ceiling imposed by the U.S. government. By 1971, Nixon was forced to end the gold standard entirely. In 2001, gold bottomed at $250, just as central banks began flooding the world with liquidity after the dot-com crash. By 2011, it had surged to $1,900, again before anyone admitted that confidence in fiat was draining away. This pattern isn't speculation, it's a signal. Gold rises not because people are afraid, but because the system is lying. Numbers are manipulated, rates are frozen, debt is monetized. But gold doesn't play along. It moves silently, signaling that something deeper is breaking. Why does it always rise before the crash? Because gold has no counterparty. It doesn't promise, it simply is. And when trust in promises evaporates, the world returns to the only asset that doesn't blink. Some economists call it barbaric, yet every central bank holds it, quietly, persistently, even as they deny its relevance. And now it's rising again. Since 2018, central banks have been buying gold at record levels. Poland, China, Singapore, and the World Gold Council confirms sovereign demand hasn't been this high since the Cold War. Why now? Because the cycle is nearing its edge again. Debt is outpacing GDP. Currencies are decaying invisibly. Trust, once global, is now fractured. And gold, silent, immutable, real, is rising first, again. This isn't a theory, it's a pattern, one that repeats before every regime change. From the gold standard to Bretton Woods, from petrodollars to digital currencies. Always the same rhythm. And now imagine, what if this rise in gold is not a spike, but a signal that another system is quietly dying? In the early 18th century, gold was not yet a global standard. Currencies were local, chaotic, and trust-based. But something shifted in 1717. The British Empire, hungry for commercial dominance, needed stability. Enter Isaac Newton, not as a scientist, but as master of the Royal Mint. He made a seemingly technical decision to fix the price of gold at £4.25 per ounce. What looked like a measurement became a mechanism. This wasn't just about pricing, it was the birth of the gold exchange standard. A silent transition from silver to gold, disguised as a technical adjustment. And yet, within decades, gold became the core reference for value across empires. Why gold? Because it did what paper could not. It restrained, it stabilized, it resisted political manipulation. Gold was value you could not print. As Britain expanded, gold went global. The 19th century saw the full rise of the classical gold standard. £1 sterling was backed by a fixed amount of gold. Other nations followed. By the early 1900s, the world's dominant currencies were interchangeable through gold. It was a self-regulating, trust-enforcing machine. But behind this elegance was a hidden trade-off: constraint. Governments couldn't spend beyond their reserves. Wars were harder to fund. And recessions couldn't be stimulated away. The gold standard punished excess and rewarded discipline. Then came the cracks. World War I shattered the illusion. Nations suspended gold convertibility to fund total war. After the armistice, they tried to return, but the system had mutated. Gold no longer disciplined, it constrained recovery. By the 1930s, it collapsed again. The U.S. devalued the dollar. Britain left gold entirely. Then came Bretton Woods, a new system, still gold-linked, but centralized under the US dollar. And yet, every version of the regime, from Newton to Nixon, carried the same DNA. Gold was the fallback, the circuit breaker, the final arbiter of monetary trust. Every time confidence in paper faded, gold resurfaced. It didn't move. It waited. This context matters because it reveals a deeper rule of the monetary game. When belief in policy fades, gold becomes policy. And belief, as we'll see, always fades. By 1965, the numbers no longer matched the promises. The United States had committed to backing every $35 with 1 ounce of gold. That was the deal under Bretton Woods. But by the mid-60s, foreign central banks had begun to notice a quiet contradiction. There were too many dollars and not enough gold. The Federal Reserve had been expanding the money supply, not recklessly, but steadily, to fund Vietnam, social programs, and global influence. At first, it didn't matter. The world trusted the dollar. But trust has a half-life. Between 1959 and 1971, the U.S. gold stock fell from over 20,000 tons to just 8,000. Meanwhile, the number of dollars abroad, eurodollars, military spending, aid flows, kept rising. The U.S. was exporting paper and importing goods. It worked until someone called the bluff. France was first. Under Charles de Gaulle, the French central bank began demanding gold in exchange for its dollars. Not as an attack, as a test. The test failed. Washington panicked. In 1968, a secret agreement known as the Washington Gold Pool collapsed. 8 central banks had been quietly selling gold to suppress its price. But now the demand was unstoppable. Gold surged. Confidence cracked. And the dollar's illusion of convertibility was exposed. What did that mean? It meant the U.S. could no longer honor its promise, not without draining Fort Knox entirely. Gold wasn't just a metal anymore. It was a mirror, reflecting the gap between what was said and what was real. Then came August 15, 1971. President Nixon appeared on national television and closed the gold window. No more convertibility. The system was dead, without ceremony, without debate. That moment was sold as temporary. It wasn't. It was the end of the last real constraint on fiat money. From that day forward, every currency became a belief system, backed not by metal, but by policy, debt, and trust in technocrats. And still, gold kept rising. From $35 to $850 within a decade. Not because of war, not because of crisis, but because the veil had been lifted. The money was no longer anchored. The anchor had walked away. The paradox? A system built to ensure stability had become its own undoing. The promise of convertibility made it vulnerable to being tested, and when tested, it broke. Today's currencies carry that same architecture, confidence-based, constraint-free, floating on promises. But gold still waits on the other side of the ledger. The post-war monetary system was not built on honesty. It was built on convertibility and credibility. Under Bretton Woods, every foreign central bank could convert dollars into gold at $35 an ounce. That was the rule. But it was a rule that relied on one assumption. No one would actually do it. The U.S. had printed far more dollars than it had gold, but so long as trust held, that didn't matter. Trust was the hidden asset. Gold was the silent liability. Here's how the imbalance worked. In 1950, the U.S. held 70% of the world's official gold reserves, over 20,000 metric tons. That position gave Washington enormous monetary power. It could issue dollars freely, and nations would treat them as if they were gold itself. But by the 1960s, something changed. The U.S. was running persistent trade deficits. Dollars were flowing out, to Europe, to Asia, into offshore banks. Foreign central banks were accumulating massive reserves of dollars, without the gold to match. This created what economists call Triffin's dilemma. To supply the world with liquidity, the U.S. had to export dollars, but to maintain confidence in the dollar, it had to preserve gold reserves. These two goals were fundamentally opposed. One required expansion, the other restraint. And then the arbitrage began. Some central banks, like France, realized they could convert dollars into gold and profit from the imbalance. It was risk-free. Take inflated dollars, redeem them for undervalued gold, a trade the system couldn't survive. The U.S. response? Intervention, coordination, manipulation. The London Gold Pool was formed in 1961. A group of Western central banks agreed to sell gold into the market to maintain the $35 peg. It was artificial, a form of price control, but the illusion had to hold. Until it didn't. By 1968, demand overwhelmed the pool. Gold buyers surged in anticipation of devaluation. The pool collapsed. The two-tiered system was introduced. Private markets could trade gold freely, but official settlements stayed fixed. It was a split reality, two truths contradicting. But gold saw through it. Its price rose on the free market. That rise was not volatility, it was exposure, a leak in the credibility dam. Mechanically, this was simple. Gold was the constant. Currencies were the variable. And when the variables became too unpredictable, the system pivoted back to the constant. Even today, this mechanism persists. When real rates go negative, gold rises. When central banks expand balance sheets, gold responds. Not instantly, but systematically. Because gold doesn't predict crisis, it records it. After Nixon closed the gold window in 1971, the world entered uncharted territory. No more convertibility, no external anchor, just floating currencies backed by nothing but political will and institutional confidence. What followed was not freedom, it was volatility. Within a year, the US dollar lost 10% of its purchasing power. By 1980, inflation had reached 14.8%. Interest rates were hiked to 20% to stop the bleeding. It worked, temporarily, but the cost was brutal. Homeownership collapsed. Small businesses folded. Developing nations, which had borrowed in dollars, saw their debts explode. Entire economies were crushed by a system they didn't design. This was the first consequence, debt colonialism through monetary policy. With gold out of the picture, the dollar became the world's central liability. And that meant the U.S. could run deficits forever. It could print what others had to earn. The second consequence, asset inflation replaced price inflation. Once central banks understood that they could inject liquidity without gold constraints, they did. But the money didn't flow to wages. It flowed to stocks, bonds, real estate. The result? Wealth gaps widened. Asset owners got richer. Everyone else was told to work harder. But effort couldn't compete with printed capital. And the third consequence, trust was replaced with control. In the absence of gold, confidence had to be engineered. Governments introduced new tools, capital controls, currency swaps, forward guidance. These weren't innovations, they were compensations. Every decade brought a new distortion. The Plaza Accord in 1985 to devalue the dollar manually. The Asian crisis in 1997, a byproduct of volatile capital flows. The 2008 crash, inflated by credit expansion with no tether. Each event was unique in form, but identical in cause. The system was built to leak. And what about gold? It never collapsed. It simply waited. After peaking in 1980, it declined for 2 decades. But not because it failed, because it wasn't needed, yet. Liquidity was abundant. Confidence was manufactured. But under the surface, the same pattern returned. More debt, more dollars, more fragility. The final irony? The system that abandoned gold in 1971 is now being quietly hedged with gold. Central banks, once sellers, are now buyers. Sovereign reserves are shifting. Not loudly, but persistently. Because those who run the system know its design, and they're preparing for its next reset. If that changed how you view economic progress, tell me where you're watching from. They don't call it gold convertibility anymore. Today they call it price stability, forward guidance, yield curve control. The labels have changed, the logic hasn't. We are, once again, in a world of invisible imbalances, only this time they're digital. From 2008 to 2023, the global money supply doubled, then doubled again. Central banks printed over $25 trillion in fiat liquidity, not backed by production, trade, or savings, just by screens, by consensus, by belief. It worked, until it didn't. The result? Asset prices soared, wages stagnated, currencies eroded quietly, not in collapse, in dilution. Then came 2022. Inflation, long declared transitory, surged past 8% in advanced economies. The system scrambled. Interest rates rose at record speed. But debt, public, private, corporate, had already metastasized. Governments had borrowed against the future, assuming rates would stay near zero forever. Sound familiar? This is the modern version of Triffin's dilemma. Back then, the U.S. exported dollars and couldn't back them with gold. Today, it exports digital dollars and can't back them with productivity. The world is flooded with claims on assets, on stability, on growth, that cannot all be redeemed. And again, gold is responding. Since 2018, the price of gold has quietly risen from $1,200 to over $2,000. Not in panic, in anticipation. Sovereign demand is at record levels. Nations that remember currency trauma, China, Turkey, India, are accumulating reserves in gold, not dollars, because they've seen this before. Gold is not insurance against crisis. It is a receipt for crisis already in motion. It moves not when chaos begins, but when denial peaks. Consider this. In March 2023, the U.S. banking system briefly trembled. Silicon Valley Bank failed in 36 hours. Panic spread. And within days, the Federal Reserve injected $300 billion back into the system, undoing months of tightening. A contradiction? No, a signal. The system cannot run on restraint. It is dependent on expansion, perpetual, unanchored, exponential. Just like in 1968. And what's rising alongside that tension? Gold, again. Then it was called convertibility, now credibility. Then it was gold backing, now balance sheet normalization. The story hasn't changed, just the language. The mistake is thinking this cycle is new. It isn't. It's the same design, the same imbalance, the same silence before the break. And gold, as always, is speaking first. Gold doesn't shout, it waits. Through empires, resets, collapses, and reinventions, it doesn't change. It reflects change. Every time belief in the system grows too perfect, too engineered, gold reappears, quietly, persistently, like a shadow that never left the room. From Newton's fixed rate to Nixon's broken promise, from Bretton Woods to digital debt spirals, the arc is never linear, but the signal is always the same. Gold rises when regimes end, not because of fear, but because of recognition. Recognition that value and trust are not the same thing, that credit, no matter how cleverly packaged, must someday reconcile with something real. And that reconciliation always starts in the same place, a metal, a weight, an ounce that doesn't default. So what does it mean when gold rises today, again, before a digital currency reset, before a new debt ceiling is lifted, before the next emergency requires unlimited liquidity? Maybe the answer is simple. The story didn't end. It simply changed form.